Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so we're going to talk about the housing crash, the housing bubble. Everyone's been calling for it. There are four things that happened the last time the housing market crashed, okay? There was a high number of inventory, super high number of inventory, a ton of foreclosure activity. There was really sketchy lending going on. And then there was new home builders were building obscene numbers of, like they were overbuilding, right?
They were building according to demand, but yes, they were overbuilding.
But the demand was artificial because of the crazy lending and other stuff. So we're going to tackle in this video two of these factors. Now we're not going to talk about inventory because we've talked about it a bunch. We're not going to talk about home building. We have a bunch of videos on that. So we're going to talk about foreclosures and lending. So we're going to start. We're just going to go right into slides here because the slides are fun.
Yes.
Okay. So here's the first slide. It is shows that foreclosure activity is an all-time low. Now, what this slide shows is by year, the total number of foreclosure filings by year. So anything in blue is under 1 million and anything in red is over 1 million. Now, if you look 2005 and 6, you can see they were rising. And then all of a sudden, 2007 through 15, there was over 1 million a year. And then in 2008 and 9 and 10, it was, and 11, it was pretty bad, like over 2 million plus kind of that, amount. And that was like the super bottom of the market. Actually, if you flip this upside down, it basically shows like the home prices kind of followed this, right? There's too many foreclosures. They all flooded the market, created too much inventory. So what's interesting is when you get all the way to the right, 2021, 151,000 last year, which is clearly like a few percent of what it was in 2008, 9, and 10.
So a lot of that credit actually goes to the banks. I know the banks are not popular, but it goes to the banks. Now, it's not just the banks. It's also the government, not something that I'm fond of, but they actually did some things right. And one of the things that they did right is they went to the bank and said, you guys, thou shalt not foreclose, right? Yep. They said, you will work it out with borrowers. You will do forbearance. You will work this out. You will not foreclose. So then what happened was, all you had to do was mention the word COVID, and you got a 6-month extension just like that, no questions asked, and they helped you out, and that made all the difference. What it did is it kept people in their homes, so that when things started to open up, the economy started to turn around, people got their jobs back, people started making money again, then people were able to catch up with those payments and that sort of thing. So that was huge. I mean, had they done that way back in 2008, 2009, when the stuff started going south, it would have been a totally different outcome. They just didn't know that it would be such a snowball effect back then. So this time around, they had that perspective. They saw what happened before, and they said, we will not do that again because we hurt ourselves back then. So by giving borrowers who were in distress more time, leniency, forbearance, payment arrangements, whatever it took to keep them in the home, and then giving them an opportunity to come back current and move forward with the loan, that actually helped the banks. It helped the banks because it kept those assets on their books as assets rather than having them flood the market at a time when it would have been very difficult to get rid of them. It maintained everybody's values, so not just the bank's values, but it maintained the values of the homeowners, the borrowers. And then once everybody was kind of fat and happy as far as having had money because they didn't have anything to spend money on for 18 months while they were all working in their pajamas at home, then everybody started going out to buy houses, and those houses that they were buying now never lost their value, and they started to surge in value as more buyers came on the market than homes that were available to sell.
Yeah, and what's important about everything that Oana just said is when you look at that 2021 and 2020 number, you wouldn't have expected this to happen because it was counterintuitive. What you would have thought was that COVID or whatever was going on was going to be the impetus to actually wreck the housing market or harm it. And it looked like at first it was going to, because we saw the number of homes in default go up to like 4 or 5 million in default. But then we've got a whole video on this about the forbearances. And that's now dropped down to like 1.5 million, which is the normal number of pre-foreclosure activities. And then we also have another video, if you search through the channel, on the trustee sale foreclosures, and it's basically zero. Like, there's not even notice of defaults being filed. And the reason why in 2021 it was 151,000 was because all the stuff Oana mentioned. You know, the banks were working it out with people, they were just fixing it. And so the thing that was going to ignite the housing market to have it collapse or whatever didn't happen. And then, so that's the first thing. Okay, now the second thing is what was happening in lending in, before, let's say 2003 to 2006. It was pretty crazy. And we're going to show that slide right now. Okay, these are lending standards, and everything everything on here are the total number of loans in billions of dollars, where the money was lent to somebody with a credit score below 620. Okay, so you've got 2003 to 2007, and you can see $300 billion plus per year was lent to people with a credit score below 620. Many of these were subprime loans. They were multiple loans to the same person with 570 credit scores. And then magically in 2008, the standards got much tighter. Like, you could see the massive drop off there. And actually, since then, we haven't had a problem with banks lending to money with people that have very low credit scores. As a matter of fact, there's something else that's not even showing in here, all the people that paid cash for the houses. Right. So if the market was going to tank, you would need the factors that happened before the last market. Now, what everyone does is they look at the price. They go, look at the price, it's really high. It was high last time, it should crash again, because that's what it did. But you don't have this happening. And the other thing was, you don't have what we showed on the other slide. You don't have the foreclosure activity. You don't have the lending stuff. Without either of those, you're not going to get the inventory, the high amount of inventory that would cause it to crash. And we don't have the home builders. That's another video we did. It's at a record low. Right. Less homes have been built in the last decade than any decade. You have to go all the way back to the Great Depression to find the same number of homes being built in the last decade. There's very few homes being built.
So to kind of put it in perspective, a credit score of 620, if you're a landlord, you probably wouldn't rent to somebody today with a credit score of 620, okay? Yep. Let alone below that. I mean, we've talked about this before. I do property management, and the tenants that I'm getting are tenants that have a credit score generally of over 700. So these are tenants with a credit score of over 700. So they're not borrowing, hundreds of thousands of dollars to purchase a home. They're just renting, and they've got good credit scores. So people's credit has improved, and a lot of that, I think, also has to do with what's gone on in the last few years. The one upside, I think, of COVID, or one of the upsides of COVID, has been that people have been saving money. Generally, Americans love to spend money faster than we make it, but over the last couple of years, we haven't had a whole lot to spend it on besides Amazon, and there is a limit to what we can store from Amazon. So at some point, we stopped even ordering from Amazon, right? And so we haven't been spending as much money as we normally do. Our savings rate is the highest it's ever been, and we're paying our bills. Hence, everybody's credit has gotten better, and lenders are requiring good credit. I mean, really good credit to do loans. So they're doing better loans because the borrowers have a better credit score and they've been more responsible with their money management. Lenders are doing better loans because they are requiring down payment, which means that buyers have some skin in the game, which before they didn't. Because remember, before, buyers were getting 100% loans, and then they were borrowing another 10 to 25% on top of that on a second to go buy a boat or a car or go on a vacation or whatever. So that's not happening anymore. So everybody's kind of walking into a purchase property with equity because they put money down, right? And of course, as properties have appreciated, then borrowers have even more equity. So that's part of what's happening here as far as the lending practices and the foreclosure side. People have equity, makes it less likely to foreclose. Lending is more responsible, makes it less likely that people will default. So it kind of all goes together.
Yeah, I think that historically, when you look at homes, they tend to go up, 3, 4, 5% a year. And people are used to seeing that. And when they go up more than that, people worry a little bit, especially, if you're getting ready to buy. And then people are worried about timing the market. And funny story, we're on a plane coming back from Hawaii, and the woman next to us said, "Oh, you guys are in real estate, and I'm thinking about buying a house." And there was a real estate broker sitting across the aisle in our market in Vegas. He goes, "Don't do it." He goes, "Wait a year." He goes, "There's millions of homes that the banks are getting ready to release into the foreclosures that they've been holding on to." And we don't say a word. And I don't even know who this guy is. And we don't say a word. We're just sitting there kind of like, it's there are all these millions of homes, but we see the notice defaults. We've been watching them for years because that's the business we do. We actually work for the banks when they foreclose on the homes, and there aren't any foreclosed. Banks haven't foreclosed. It's not like they foreclosed on a home and are holding on to it. As a matter of fact, if the bank foreclosed on a home, they want to sell it immediately and get their money. Actually, if a bank was foreclosing today, they would immediately try to put the house on the market and sell it and get as much money out of it they could. They would get all of their money back, and then whatever money's left over would still go back to the borrower. So there's really no incentive to hold on. It would be dumb for a bank to hold on to a house or a bunch of houses or millions of houses, that's going to release. They would just do it. There's no law or anything happening right now that's stopping banks from foreclosing or that's stopping a bank from selling a home that owns its inventory.
Right. But like we said, people have equity in their homes from the moment that they close escrow on it because they put money down on it. So generally speaking, there are very few and far between homes that don't have equity in them. So selling a home on the open market in a traditional way is a very possible thing. The other thing is, remember, there are lots of other avenues to sell homes now, not only through regular channels, but all the different investors that send you the little postcard saying, we buy ugly houses, or we'll pay cash for your home sight unseen, or whatever it is. So there are lots of ways to sell that property so that it never goes to foreclosure and the debt is paid off and everybody's good.
Yeah, and if you own a home, you're probably getting tons of text messages, postcards. We're thinking of buying your house. It probably even has a picture of the front of your house that they grabbed off Google Maps. And they're just trolling, trying to get somebody to sell low, and then they're going to flip it. That's what they're going to do. They're not going to buy it and keep it. They're just going to flip it to somebody else.
Right. So, it's not uncommon to get a postcard in the mail with this cute little family with a dog and a cat and little kids and saying, "Oh, this lovely family would love to buy your home, blah, blah, blah." So, look, agents, buyers, investors, they're all trying to find homes to purchase because they understand that homes are a good hedge against inflation and they're a good investment, and they're trying to purchase homes in a market that does not have a lot of homes on the market. So they're trying to find the homes that are not on the market yet.
Yeah, actually, there's a community about a mile from here, and there's about 400 houses in the community, maybe 500. And Oana said, "Hey, get an active listing. I want to go in there with a client." The homes probably go from 600,000-700,000 to multi-million. And I went in the MLS really quick and did a search. There was only one house available of the hundreds of houses. So, like 0.2%. There was only one. It was the only house. It was the only one that was available. There was nothing on the market, which is unusual. You would normally see a ton of houses on the market because the price and range is so high. There would be a bunch of houses sitting on the market for a long period of time. And these, super multi-million-dollar luxury houses, there wasn't anything. They're either all sold or tied up, or somebody's sitting on them, not selling. So
right. So to Todd's point, as far as luxury homes are concerned, it's not uncommon for luxury homes to not even be put in the MLS, but to be sold off the MLS because there is such a vast number of buyers in that price range, and these people that have these luxury homes are choosing to keep their situation private and not have their home on display for everyone to see on the internet, and just sell their home privately with an agent still, but it's an agent-to-agent transaction versus having the home be on the open market.
Yeah, and agents, this is kind of a little known thing. In the luxury communities, there's usually a few agents who kind of work all the deals in there. And if you ask an agent who tends to work the luxury market, they know each other, and then they kind of know what little communities they all work in. and then you're usually collecting names of people who are thinking about buying. And then the other thing too is you have people who moved in those communities and they're renters, and they go to the agent and go, hey, look, I'm a renter, I'm paying $5,000 a month, but I really want to buy a house. But I wanted to live in the community for a year before I, dropped $4 million on a house. So I really like it here. I want to buy a house. So if you get something, let me know. And then, someone will call them and go, hey, we need to sell the house, but we don't want to, because we own a company or whatever, we don't want alarm people that we work with or whatever. And so we just need this kind of private, quiet sale. We don't want to put it on the MLS or anything. And then sometimes they'll just go right to the person and go, hey, they want to sell it. Let's see if we can just do a deal. And it happens. It probably happens more in, niche communities than it does just your general listing. Because your general listing, you want to put it in the MLS, you're probably going to get more money for it than if you just try to one-off it.
Right. So, in Las Vegas, if you have a $15, $20, $25 million house, it's very unlikely it will be in the MLS. It is very likely that it will be sold privately with brokers, but not out on the open market. Because like we said, there are probably maybe in Las Vegas about maybe 25 teams that are very strong in the luxury market. And if you have a luxury client, this is who you go to. You make 25 phone calls and say, hey, what have you got? And they'll tell you what they've got, and then you can put a deal together.
Yep. So anyway, if you made it all the way to the end of the video, thanks. Please share it. Leave us your comments and hit the notification bell, subscribe, all that stuff. Watch all the other videos we have on the channel.
And if you have a luxury home and you've sold it in Las Vegas, or you're thinking about selling it in Las Vegas, we want to know what you think is going on in the luxury community as far as whether you want to put your home in the MLS or you want to do it more privately. Let us know. I'm always curious to know from the client perspective how that works.
Yeah. All right. Thanks for watching, and we'll see you on the next video. Bye.